Hello, everyone. I'm Gene Massey with Mediashares, moderating the alternative credit panel. And I'm going to let everyone introduce themselves, starting with Brad.
My name is Brad Laddusaw with S&L Capital Group. We're a California-based asset-based lender that writes acquisition bridge loans to real estate investors acquiring 1 to 4 unit properties, multifamily, 5 to 20 units, industrial, and select office space. We privately place all of our loans with high net worth individuals and family offices in the form of trustee investments. Duration on our notes are anywhere from 12 to 24 months.
And we've got Bill and Kendra on by Zoom. And I guess we should start with Kendra.
Ladies first.
Oh, Bill was ready to go.
Okay, okay, Bill.
No, ladies first.
So my name is Kendra Rommel. I am the co-founder of a company called Futures Financial. Much like Brad, we specialize in first trust deeds secured against residential and 5+, so multifamily, bridge, ground up construction, value add, and stabilized DSCR style product. Our company is pure balance sheet and or backed by first trust deed funds, alternative debt funds that are closed-ended and offer a pref return in each of them. And we currently hold no institutional capital, so it's kind of exciting. We feel like we're maximizing the market as we so choose, and we're actually, as much as it's a challenging time, we feel like it's a very opportunistic time. So thanks for having me.
Sure. Bill?
Yes, my name is Bill Bymel. You can hear me okay, right?
Yes, sir.
Great. I founded First Lien Capital 3 years ago. We are a seasoned whole loan buyer, so we do not originate mortgages. We buy other people's mistakes, primarily NPLs, some performing and subperforming. And I've been in the business for about 15 years. I actually met Kendra back in 2009 when we were both in the distress space back then, just getting into it. So
Great. Great. I got a good question that I'll toss it out to any of you. Everyone wants to know about interest rates. So why don't we go down the line and tell us a little bit about your interest rates, and are they going up, going down, and are they going to get terribly worse? What are your opinions? Brad, you want to start?
Sure. And I know you guys are like right behind me on the screen, so it's kind of weird. I feel like you're talking behind me, but I know you're there. Interest rates. In the asset-based space where I focus, and I think it's more so reverting back to the mean. When I first got into the industry in 2013, didn't matter how experienced you were, everything was priced at 2 points, maybe 3 points origination, and 12% interest only on investment properties. Now, currently, our portfolio, we're flowing anywhere from 9.99%. On the high end, we did 11.75%. That was a unique situation, but that's the current range we're in. I actually think we're probably going to see us holding in that range. I don't see it ticking up much higher, at least for California. What we're seeing in other markets across the country, deals are being priced more to the risk. So you have some pockets where you can charge 12, 13, 14%. Whereas a few years ago, when institutional flooded the marketplace, it was blanket pricing across the country at leverage that was probably unsustainable. But that's where I think rates will probably be floating in the next 12, 24 months.
How about you, Kendra?
I mean, much like Brad, you're going to hear me kind of echo a lot of sentiment because Brad and I share similar space. You know, for Bill, it's buy rate. For us, it's what are you taking it to the street, and what's the since Brad kind of addressed what he's taking his loans to the street as, which is just pretty much market. I would say we tick up. We will go anywhere from 9.99 to 12.5 to the client in an investor scenario. To our investors on the back end, or our first trust deed investors, I would tell you that rates have definitely shifted by 200 basis points or more. So cost of capital clearly affects the push out to the street. Obviously, we could all sit here and say how much we just, adore the times where cost of capital is low, but I actually am excited about the market returning to where it should be. The private sector when I originally jumped in or was exposed to the private sector out of banking, we actually were selling 15% private money loans and 5 points, and the max leverage was 55 on a really great day if we loved the asset, 65. And consumer banking space was closer to what private money rates were going for at the 9.99 to 12. So, I mean, look, I don't see how we're going to pull rates back down when we have a country that's in the deficit it's in and acquiring debt at the $1 trillion range in 90-day increments, right? So I just don't, I think the focus is incorrect when we talk about interest rates, but I do think now is the time for investors that have capital that want to place it in solid returns and make some solid money. Now is the time to look at alternative credit for sure.
Now, Bill, you're focused on the distressed market. Can you tell us a little bit about? Obviously, your rates are going to be a little bit different, and you want to comment on that?
I want to answer the other question first, which is what do we think about interest rates? And I love this topic. This is actually something that I speak about a lot lately. Rates are not going down. We're not going to see 0% rates again. And it's a fallacy to think that these are not normal rates right now. I hear every day, I hear somebody say things will be fine once rates drop to normal levels or something along those lines. It's just a fallacy. We're still at a average rate in this country in the low sevens is still below the median average historically, which is like 7 3/4. So, we've got to get used to that. And that's great for me because all this 0 to 5 or 0 to 6 movement from a financial and mathematical point of view is such a gargantuan shift in the cost of capital that it's causing dislocation all over the marketplace. I've been waiting for this, as a distressed debt buyer. I'm gonna get Kendra back into my side of the business soon.
So
we all thought it was when COVID hit, and then obviously we dropped a couple $1 trillion of printed money, and it just paused the inevitable. Markets are cyclical. Rates needed to come back up. We need to get back to a normal society where, deals are penciled logically and not because the capital is free and the value's inflated.
So, Bill, I know it depends on the risk, but can you give us a spectrum of what we're looking at?
Back when rates were 0 a few years ago, my competitors were all having to bid to single-digit deals and having to lever to get into the double digits. Historically, as a non-performing, sub-performing buyer, I've always had the mandate to be mid-teens and try to be mid-teens unlevered. And in the last couple of years, that's been a very hard market to play in. So I've had to buy onesie twosies, go to places like New York where others won't go. Now it's, the market's coming to us. So we can buy performing paper, scratch and dent, fanny fall off stuff. You can buy in the 80s, if it has low coupon. You can buy the non-QM stuff that people can't refinance. There's lenders that have to get it off their line. It's hard to get them to not sell for to sell below par, but a couple points, maybe a little bit of a discount. The stress is getting more. So now I can model my NPL deals in the mid-teens unlevered, and I'm right in line with people. But now that means that I'm going to go for the 20s.
Are you seeing more distressed loans now than before?
Yes, obviously most of the distress right now is in the commercial side. Sponsors that are getting, on the multifamily side, it was never realistic that low-rise complexes in middle America would be a 5 cap long term. It just wasn't a realistic play. Math, the math is working itself out. Yeah. And so there's a lot of distress in multifamily. There's a lot of distress in commercial, obviously office and major metros. So I like to be the guy that runs into the burning building. And
let's go. Yeah.
Since Bill, since you're addressing distress in multifamily, there was an article, I don't know if it was in the Wall Street Journal, talking about the CLO market and how, the distress that you've seen in office, there's kind of a little bit of contagion of it going into multifamily in the form of CLOs. Any thoughts on that?
I'm not a CLO guy, so I don't know a lot about that, how that plays into it. Do you have thoughts on that, either of you?
I could touch on the pain on multifamily that I see coming down the pipe. I think it comes down to unit size and mix. I think your larger multifamily, call it 35 units plus, getting hit a whole lot harder than call it 15 units and below. I think we're going to continue to see that. Those larger deals, it's also a source of capital. How are they funding their equity piece? A lot of those larger deals are syndicated with private investors as well. So you're looking at that GP or the borrower on paper, sponsor on paper, may actually have very little of their own capital in those actual deals. Missed the mark on valuations, of course, on the takeout with interest rates, how quickly they ran up. So you're going to see I think, a lot more pain on that side.
So I think one of the things that Tyson also was talking about earlier was how things are priced to perfection, right? And there's been this whole craze of just multifamily communities selling like crazy for the last 5 or 10 years from one buyer to the next. And I guess leverage was an important player back then. And like, I'm not talking 35 units, I'm talking 300 units or 400 units. Maybe you have any comments on that?
Well, just on those, you look at Texas, for example, a prime example, you had regional banks that were competing with hard money lenders on the leverage they were granting at extremely cheap pricing. In California, First Republic was probably one of our biggest competitors with multifamily bridge. They would do 24-month terms, high leverage on a value add play, but we've had a shift on how banks are looking at takeout financing. Now they're not underwriting to a 4 cap. They're more conservative, call it 6.5, 7, which is a huge disconnect. Whereas
with their leverage versus your leverage or versus our leverage.
So on my leverage, I'm not a big fan of the multifamily high leverage value add play because it's impossible to evict anyone in the state of California. So we would be at anywhere from 60 to 70% of the purchase price, where they would push, I think, 75 plus at times for a client that has good amount of deposits, and they're banking that on that longer term value add play. But if you can't get your tenants out in 12 to 18 months, you're going to miss the mark on your renovation budget, because we all know what happened to the cost of materials in that post-COVID area. Look how quickly interest rates ran away in 2022. Now you're in I don't know if I can use this term, but you're really pissing into the wind on some of these deals. And I think that is still working its way through, and we're going to see, I think, more of it.
Well, this kind of leads us to the subject of risk and how I'd like to go down the line and see, how do you assess risk? And also, do you feel like AI and automation are going to help in assessing that risk? And can we start with you, Brad?
Actually, Kendra, you want to take that one
Kendra?
since I'm kind of leapfrogging you on every single one?
With risk, as it pertains to risk.
Yes, the risk and what's the future going to hold for that? Is AI going to help assess that risk? And is it getting worse? Is it getting better? Or are we headed for some tough times? What's your opinion?
I mean, look, I can only hope that AI is going to assist. I mean, I want to spearhead some of that in our own capacity. I'm a firm believer that it should be assisting us at this point, much like Jessie was touching on when she was speaking. Look, it's a tool. It's a tool to be better and create efficiencies within our space, or any space for that matter. But specifically, the private sector, we're so antiquated. I mean, you could go through the banking space and see that, there's desktop underwriters as an example that's been around for years, right? They're assessing the underwrite on that deal. We don't have even that much support from a technology standpoint at this point, but I think I really believe in my heart it's coming. It's the people who are willing to take the time to do it. But in terms of risk, look, how we look and underwrite deals at this point, it's not just about the origination. It's the stress on the exit is probably just as imperative, if not more, for the same thing we were just talking about. So we were just talking about how commercial is potentially pushing into a distressed marketplace, like from a multifamily or a larger multifamily perspective. And I think the bigger look is that you're going to see, not just in multifamily and commercial, but also like high-end luxury, you're seeing a bunch of people forced to right-size projects that they don't have the dry powder to right-size. And so you see, this is why Bill's smiling, because Bill's like, yes, sir, that's why I'm taking those. And to the same extent, lenders haven't prepared themselves with their own dry powder. Therefore, just like Bill was expressing, they're being forced to right size their facility lines, which have been their primary business model, and Bill's right there to scoop them up, whether it's onesie, twosies, or a package. So in terms of risk assessment, I think we're in a time where we specifically as an organization utilize technology. I mean, we have manual underwrite, a manual QC that we back up or support with tools, technology tools. And that's things like checking wire instructions. These all seem simple and basic, but they have saved us so many times. I mean, we've killed over $20 million in fraud in one single month because technology was there to support what the human eye couldn't. So I think, yes, absolutely, we're in a time where that's important, coupled with kind of A, B, and C business plan for whoever's coming to us for financing, and also to invest, to be fair.
Mhm. Mhm. I would like to comment on the risk thing.
Yeah, please, Bill.
And that, I'm not looking at it from the origination side, but I'm looking at it just from an affordability side. I think the conversation going forward is not going to be only about PI, but it's really going to be about TI. The insurance problem in this country is real. And it's just a factor of whether you believe in global warming or not. It's a fact. And we are now at a point where this country is seeing billion-dollar catastrophic events every 3 weeks as opposed to every 3 months. And you're seeing insurance. And so that whole factor is a risk that I think the banks and the lenders are just starting to grapple with. I spent 2 days at a think tank in DC last month over this very topic, and it's a real issue. Insurance, and then obviously the cost of taxes as property values are so high.
All right, risk, loaded question. Where do I start? It's not all doom and gloom. I think you're not going to yield anywhere from 9 to 10% without taking any risk. As an investor, let's go on the active side, individuals acquiring real estate. Which way are property values moving? They need to be very, very accurate on their purchase price and their estimated stabilized value. A lot of moving parts. Second half of 2022, when interest rates started running away, I like going to the California Association of Realtors website for single family residents. They post everything 1 month lag, historical data. You could download it in Excel. I was actually looking at it with our month end close the other day, and you could trend this back to the Great Recession. You look at where interest rates are running away in 2022, property values, SFRs, detached, median sales price pulled back about 17% across the state as a whole, per their numbers. It bounced back very quickly thereafter, and then it pulled back again. So it's been very volatile. So if you're a value add investor, there's quite a bit of moving parts going on that will add to your risk. If you're doing a value add play on a rental property, the legislative risk, I think, is one of the highest risks that you're going to take on in the state of California, keeping it specific to California, because that's where we invest money.
By rental, you mean like a multifamily?
SFR,
Short-term rental?
across the board. So if we're going, let's go to a long-term rental for starters. If you're acquiring a property that's, hey, we're in Los Angeles, good luck evicting somebody in the city of Los Angeles within 12 months. They have changed some of their eviction laws to where it's damn near impossible. Multifamily, if you have tenants that are getting together and they lawyer up, you might as well just get rid of that property. Short-term rentals. It's been, look at Joshua Tree, for example. Post-COVID, Joshua Tree went from properties selling for 250 grand, pushing some close to $1 million. The dirt is not worth $1 million in Joshua Tree. I'm sorry, but it's a short-term rental boom that drove that. Then they started restricting licensing. So once this local city start restricting licensing on that short-term rental play, the Airbnb play, now if I paid 800 grand for this property that was worth 300 grand 2 years ago, and I can't renew my license next year for my short-term rental play, what's my property worth?
Hasn't Airbnb been restricted here in LA, like in New York City? Or?
Oh, you pick the city, and that's where it gets difficult, because it can vary by city. San Diego a couple years ago changed those, and they limited the amount of permits they're going to issue per year per city. So it's kind of a crapshoot there, and you have a lot of people out there. Not in my backyard. They like the strategy, but they just don't want it in their backyard. Now, if we're shifting the risk to passive investors, I think there's a lot of risk for passive investors because debt funds have popped up. I compare it to the hedge fund boom of 2013, 14, where you go to a networking event, everyone you met was a hedge fund that was implementing a long short strategy, but they couldn't explain their strategy. Commodity sell-off at the end of 2015 wiped a lot of them out. We've had debt funds pop up and reproduce like rabbits over the last few years. There's a lot of good operators out there, but there's some bad apples, and it's just really easy to raise money. So I think there's risks as a passive investor investing in some debt funds or even some firms structured as myself that are too far removed from that borrower. I think the farther away you are from that borrower, the riskier that deal is.
I remember seeing in Airbnb, it's so bad, the evictions there are so bad, somebody rented a place Airbnb and they couldn't get him out.
No, really?
Yeah,
Yeah, it's a luxury property too.
that's how bad it is.
Really?
Yeah.
Just to follow up on what you were saying, I thought you made two
A
very good
question from the audience here? Oh, go for it.
The question is, the government is printing so much money that the banks are going to go broke. That's number one. Number two, the rental houses in Los Angeles, about every place, and a lot of people are moving out of Los Angeles, and that's statistically done today. So you're a realtor. I am a broker, so I understand everything.
Yeah.
What you're doing. What is that you recommend to the people, or at least give an opinion, what to do? Because people are leaving. My friend Elon Musk moved out of here. He's in Texas. And a lot of people are going to Texas, Miami, Idaho, South and North Carolina. Because first of all, we got a quote unquote, some government that is doing the right thing. And people are moving because taxes, the federal rise. Gasoline is going to go 2 cents a gallon. That goes to the government. We already pay like about under $1. So we got a problem here that we have to solve.
Yes.
All of us.
Well, if you've got any solutions, I'm sure they would love to hear about it.
I'll
Now-
live it to solve problems, it's just to make money off of it.
Right.
Yeah.
So I've got a really good one here. We've got
I'll answer that for you later.
number of family offices. If I'm a family office, how do I work with you? How do I make money? What are you looking for?
Right.
Kendra?
If you're a family office, how do you make money with our company, Future?
Yes.
Specifically?
How do you work with family offices? Do you
Well,
loan them
we
money?
first
Do you
find
take
out what
money
it
from
is-
them?
What we would first want to know what their appetite is, right? To make sure that it's a palatable relationship for both sides, because as much as it's great to hear how much money somebody has, I feel like not everybody is a good partner for us. But and more importantly, we for them. So assuming that they wanted to invest in first trustee debt funds specifically, the way we have structured our deals in the past are, like I said, they've been closed-ended funds, not evergreen funds. There's a PPM and subscription agreement of which it outlines our credit box and wheelhouse, so to speak. And we agree on a committed return to the investor. And our funds, unlike a lot of funds and a lot of funds that are evergreen, we are, like I said, a pref return. And so despite performance, whether non or performing, you're getting paid on the first of the month. Your investors are making their money. So that's something we pride ourselves in. We've had zero capital loss. My business partner is amazing at what he does. Thankfully, I get to go out and spend the money, and he and control operations, and he raises capital and manages the capital. And I would say, just like Brad just mentioned, literally, I think it's really, I don't think it is easy to raise good capital and proper capital, whether that's family office or other private investors. I actually think it's extremely challenging to find partners that we want to be in bed with, but because it's a massive responsibility and liability on both sides. But it is extremely easy to get in bed with the wrong partner. And so I just think for us, we encourage our partners to do due diligence on us, and we make sure that the deliverable is something that we can accomplish on both sides before we even ink any fund structures for them. But again, that's all our business is. It's backed by a family office, mostly of self-directed IRA funds and some additional, but that is our business model to date and our own balance sheet, and we participate. And we're on our fourth. We just closed out our third fund, and we're on our fourth fund.
Can you all address like your capital stack, and are you the primary underwriters of the loans that you're doing? Or whether you come along as a co-investor on those loans? Because it seems like the loan business has changed over the years. From people used to be the primary one and only investor, where now a lot of these loans are syndicated. So can each of you address that?
Yeah.
Sure, I'll jump into it. So
How many family offices do you have right now?
Why don't we just
For the
Listen, just do
and then
that,
we'll go to the-
do Marty's
How
question
many
first.
family office do you have?
So let's do the capital stack
I'll add
question,
that.
because that'll address the family office at the same time.
yeah, so capital stack, we're backed by high net worth individuals and two different family offices that are strictly looking for yield. We are your traditional old school asset-based lending company where we don't syndicate or fractionalize our loans. We privately place our whole loans with a high net worth or family. In the state of California, if you're actually investing in trust deeds through a licensed broker such as myself, you're capped at 10% of your net worth per loan. So that's why we seek investors with a net worth that will at least cover our average loan amount, which is about $550,000, which puts their net worth in excess of 5 million. So that's our target on our capital stack and our investor base over the years. I call it, I hate like raising money. I just don't like doing it. I have passively raised money. What I mean by that, a lot of our investors have been referred over to us over the years by current investors or from public speaking engagements. But to go out and solicit investors, I can't do that. It probably hurts us a little bit, but we haven't had a need to do it. But that's our current capital stack and how many family offices we work with.
Kendra and Bill?
I have a closed-end Reg D fund, first lien NPL opportunity fund. My partners and I all invest our own dollars alongside all of the investors. So we are co-invested in every single deal. We do syndicate occasionally pieces of our deal, but not like out, we control everything and manage everything and are invested in the primary principal in everything that we buy. And we will work with family offices that anyone that's looking at a check of 20 million or more, we could do a separate deal with.
Okay, Kendra?
Yeah, so like I mentioned, we're backed by a family office. We have 3 closed-ended Reg D funds. We do have our CFL, and then of course we have our own high net worth individuals pulled together outside of the fund, along with our balance sheet. So that's our capital stack. And
Brad?
to answer Marty's question further, he asked, has it changed? I would say coming out of the institutional private lending space, it has changed like 360 by force. Like I stated earlier, just like investors in the marketplace with boots on the ground, lenders were forced to right size their organizations. And what I mean by that is, CS used to be a major player in the space for the company I worked at, right? They completely dropped off when COVID, just halted everything and margin called everyone and just hit the skids for those that know. And so people were forced, if they had anything on a warehouse line, to make that good at whatever degree their bank or their institution that held the warehouse line felt necessary based on the risk that they had thrown on that line, right? So in that turn of events from COVID forward, I would say definitely from COVID to 2022, when I left the institutional space, there was drastic movement from a secondary perspective, changing what that would look like and changing the appeal. It used to be something to like pound your chest about, that a bank was backing you or that you were backed by you just completed a securitization of whatever, or that you were on a revolver or a public REIT. those days quickly shifted, and the attraction became who has the private capital that can make business decisions and stay fluid in closing deals, not just closing deals, but for people like Brad and I who are financing construction or construction draws, who has the ability to continue to move money and release our funds without, restriction. And so capital has 100% shifted from an optic standpoint, but also a functional standpoint. And the appeal to alternative credit, just like we're sitting on this panel today, is obviously increasing by the minute. Attorneys are pumping out the desire for people to create these debt funds as if that's the only thing to do when you get a debt fund, So things have.
Go ahead, Brad.
And I just want to add one thing we touched on risk, and we're touching on exposure to investing in debt. In California, everything is publicly available. It's tough to do business in this state. We all know that, but it's a blessing that everything is publicly available. So my company, you could go straight to the DRE's website, verify our licenses. If we ever went through an audit, they actually post that audit accusation and findings on their website. And if you're investing in a debt fund that is licensed under a CFL, you could verify their license. It's a little trickier name, Kendra, but they could go and verify any CFL license holder. If they went through an audit, it is actually posted to their profile as well. So I think those are very quick heat checks any investor or family office can do just to kind of verify who they're working with, because you do need a license to originate loans in this state, and you do need a license to privately place loans in the state of California. And that's something that I very rarely get asked, and I should get asked, but you could independently verify damn near anything in California.
Okay, here's an uncomfortable question. What happens when your partners are unhappy? Maybe you never have an unhappy partner, but what happens when somebody's unhappy and that you're working with? On both sides.
Like business partner or on the
Both sides.
Okay. You want to take that one first, Bill? I'll jump right into it, but I talk too much.
It's so funny that you say this because I literally just signed yesterday a document to buy 30% of my GP back from my partner. But we have joint ventures with institutional partners, and it's not easy keeping them happy. We went into some of these relationships knowing we were dealing with hotheads, and so I just try to under promise, over deliver, be very clear with my words, not get emotional, not take anything personally. That's a big one because it can get hairy. But and not make things personal either. The guy I started my company would not exist without him, and it stopped working as a partnership, and we didn't agree on where the future was going. So we spent 9 months figuring out how to not blow up the company and figure out how to make it work, and think so. Does that answer the question? I don't know if it does, but that's my take.
Yeah, from you. Let's hear from you, Kendra.
I mean, I'm just a proponent of communication. Maybe that's the benefit of being a female versus a male in the space. I think that with communication and transparency, you hedge a lot of just discontent or disease in any organization, whether that's internal or external. And I think communicating the expectation, both at the onset and periodically throughout the relationship, creates ease of doing business with partners in general. I think disclosure is, and I don't say that because I like contracts. I say that because we all go through things in our life. We're all human beings putting on our pants or our skirt the same way. And we, at the end of the day, whether people are choosing to trust us to put their money with us, or choosing us to finance them and be there for them to supply the capital in their projects, they're putting a massive amount of trust, and their lives aren't exempt from ups and downs, just like mine isn't. And so again, I know it sounds kind of cliche, but we really have been fortunate to pick some solid partnerships and put the proper parameters in place to avoid confusion, which oftentimes causes that distress. And we've provided solutions for when things will and do go bad, how we will protect them in those circumstances so that they don't have to stress. And it's really created I mean, we're a little over 2 years in on our specific company, and we have people believing in us so much that they're asking when we're going to open another fund or launch another fund. So we're fortunate that way. And I say that in the most humble way. We're fortunate that way. We could have misstepped. I mean, somebody once told me you're one decision away from the worst decision or putting your company out of business. And I don't take that lightly, and neither does my business partner. We just try our best every day and communicate out even the times where we might have some fear.
Yeah, I remember starting, Kendra, when you were starting Futures with David, and we were talking about it, and others were levering, and you were always a much more conservative approach. And some of the choices you made today is the reason why you're, still strong.
And I think that term partnership, you gotta be very careful with it in any aspect of investing. I have one partner, it's my business partner, and that's like a marriage. I talk to my business partner more than I talk to my wife. So we could probably go to counseling together and leave our wives at home. And talking to our passive investors, at the end of the day, I am providing them with an investment vehicle and I'm selling them a security. We're not partners. We can't be partners because that's not the way we're structured. Similar with our borrowers.
You're partners with FINRA though, right?
It's similar to our borrowers. It's a very fine line. We're trying to establish a relationship. We want to be approachable, want to be seen as friends. But when you're getting sued by a borrower, you don't want to be seen as friends because then things get slippery very quickly. So it's very important to define those relationships. We don't do JV agreements on deals with borrowers because in a JV agreement, you're basically agreeing to potentially share losses as well. We've seen a lot of deals go sideways over the years on JV deals, especially large value adds. So we're very careful with that term partner. And I'm a recovering auditor from EY. So if it's not documented, it's not done. But if it's documented, that shit's documented. So you gotta be very careful about what you're putting in writing and also communicating over the phone. And that word partnership is it could be good for you, but it could put you in some deep water very quickly. So that's our
Last question, just a couple of sentences from each of you on what the future holds. What can be disruptive? What tailwinds will you experience? What can put a really monkey wrench into your works right now coming down the pipe?
tailwinds. I think as interest rates stay high, that helps us in the asset-based bridge space. Anytime a regional bank shutters a little bit or gets a little shaky, which I think we're going to continue to see that over the next 12 to 24 months, that is another potential and increased deal flow from bankable borrowers. We very much see the next 12 to 24 months being busy in the bridge space. Some things that scare me. There's a lot, but I think it's the legislative side of things that really scares me. That's going to really, I think, hurt us on the lending side. There's some stuff coming down the pipeline that will just cripple investors that are buying properties as well as lenders. So that's something to watch out for.
Now, Kendra and Bill, what do you see coming down the pike that scares you?
The government intervention is definitely the wild card. Markets need, in order to be a free capital country, we need to allow markets to work themselves out. And I get that what we did because we had the context of survival in 2020, but we need to allow markets to kind of normalize and flush out and let the winners rise and the losers die. And there are plenty of multi-billion-dollar companies on Wall Street that are dead men walking. And there are plenty of commercial real estate sponsors that have been dead men walking since before COVID. So what concerns me is government intervention preventing that from that naturally happening. Other than that, I'm excited. Shit's about to hit the fan. So I'm
Cautiously optimistic.
Kendra?
I'm just extremely optimistic. I feel like when we're all authentic to ourselves and what we deliver to the marketplace on any side of that, all we can do is educate ourselves and do what we do best and allow others to do what they do best. And I just proceed with caution, right? I'm not going to stretch to meet somebody else's expectations. It just may not. I'm okay with letting people go a different direction. So I'm extremely optimistic, and I'm super grateful again for the opportunity to sit on the panel and chat with all you guys. I think alternative credit is 100% the way to go right now.
Thank you all. Very nice.
Great job. Thanks.